Krishnan, Chairman and Managing Director at Forgings, joining us. Mr. Krishnan, your numbers, at least on the top line, you clocked a double-digit growth, but EBITDA and profitability took a bit of a knock. Give us a sense as to what's played out this quarter, and does this reverse given that there is some resolution on the India-US front?
Morning, happy to be here.
Very good having you.
So first thing is, margins have taken a little bit of a knock, largely on account of higher wages and higher power cost. As we improve our tonnage and go up, I'm sure that economies of scale will pick up and we'll be able to recoup the margins.
Okay,
so US.
Yeah, please.
You had asked one more question.
Yes,
this is
please.
about the US.
Yes, please.
Yes, the US is panning out quite well. Customers had stocked up on inventory, thinking that there'll be demand, and was the other way around. So they've run through their inventory pile up, and they are back in the market for us from January onwards. Little bit in December, and largely from Jan-Feb.
Right. But Mr. Krishnan, could you highlight specifically why exactly is there a decline in your EBITDA?
Yeah, I had mentioned labor and power costs need to be looked into.
And what gives you the comfort that will likely come off, or you can control that? Is it going to be top line growth which kind of aids that efficiency, or what is it that will get your margins back?
Two things. First is top line efficiency. Top line growth will amortize these costs, so scale will have an impact. Second is to look at optimizing labor, which we've already started with a serious set of robotization. So that also is an important strategy as we go forward to reduce our overall costs.
You had earlier guided. Right. You had earlier guided booking about 750 to 800 crore rupees of revenue in the first half of FY26. With 400 crore rupees booked in Q3, are you confident of achieving this, full guidance of 750 to 800 crores?
Yeah, all things remaining the same on the macroeconomic front, and it looks like the macroeconomic front is turning much more positive only. So that should be a real tailwind. Therefore, I should see 800 crores comfortably in each quarter, each half of next year. I think 800 would be a baseline. 800 would be a disappointment. We should do better than that in FY27.
Okay. And
on a half-year basis. So quarterly, we should be looking at something around 450 plus.
Very interesting. Okay, so upping that guidance by a wee bit, at least by 10% for H2. But talk to us, Mr. Krishnan, with regard to how the US demand is shaping up, because you've obviously got US and EU both as good levers for you to grow. So what does FY27 therefore look like as and when both of these materialize in terms of agreements?
Yeah, the Class 8 truck market in the US is very strong. Customers are giving us good indications of strong demand in calendar 26. So that augurs really well for us. We would expect the US to claw back to 15+% of sales, or at least recover the lost sales of the previous of this current year. Class 8 trucks booking is at an all-time high in America. And they are also ordering from us literally crazily, where last few months they were off the market. Now customers are screaming for parts. That's very, very positive.
Sure. The other thing I also wanted to talk about was your order book, because that stood at about 300 odd crore rupees. But as on Q3, what's the visibility looking like, and what is the expected revenue realization timeline?
Yeah. We should do at least 300 crores above what we do this year. So if we end up at about 1,600 or 1,000 I would say 1,500, 550 plus, we should look to add at least 300 crores. See, we have invested over 1,000 crores in the last 5 years. And all that, though delayed a little bit here and there, partly due to customer and partly due to our execution. So all that is coming back, and that should augur really well for us in FY27. So FY27, we should cross the 1,800, 1,900 crore mark comfortably.
And the domestic market, is the kind of growth and traction domestically also sustaining in terms of at least the growth that we are seeing on ground from the OEMs is very, very strong. I'm trying to understand whether that kind of strength is sustaining, because you will be the first port of call if that demand were to sustain.
Yeah, that's a very good point. OEs are talking strong numbers. And for the first time, they are looking at growth in FY27, at least to us. So I would say we stand in a good position, both domestic and exports. I would say macroeconomic situation has considerably changed in the last few weeks. Both on the domestic side, OEs are pushing. Some of them have won export orders. That also adds to our KTF parts. And few others are projecting domestic volumes also to rise up. So M and HCV, ILCV segments look pretty strong in FY27.
And Mr. Krishnan,
so the LCV market, many customers are asking us to ramp up and be prepared for higher volumes.
Mr. Krishnan, talk to us about India-US and what's happened over the last 9 months or so. Give us a bit of a refresh. Who's been bearing the tariffs? Because that will also likely add positivity to your margins. Your current US exports are approximately 10% of top line. Europe is approximately 20%. So this entire US plus Europe basket will account for roughly 30% of your top line, if I've got it right. Does that change materially? So two-part question. One, do your margins see an upside given this India-US resolution? Point number two, given that this is 30% of the mix, does the mix go up as a result of the agreement?
Margins, I'm not too concerned. Once we get a little bit of traction in the US, as well as improve the domestic output, we should gain back the lost margins. On the US side, customers who had virtually, it's a kind of a mini conspiracy theory, of course, very strong word to use. But from April onwards, when the tariffs were announced, customers literally went away from the market, of course, 1 month back itself. And right up to November, they were off buying because their demand had considerably slowed down and they had huge inventories of our parts. From November onwards, of course, by November itself, they've started buying parts again. So by January, when the tariff situation has changed, I think we are in a very, very strong wicket to take advantage of that. Customers have also, in one sense, they have not borne any big brunt because of the tariffs, because during April to December, their buying was at an all-time low. Fortunately for them, they stocked up on parts. Not so good for us, but they're back and no business lost. That is very, very important from Forgings' point of view.
Good luck with that in the future quarters ahead, Mr. Krishnan. Good to be speaking with you today on ET Now.
Thank you. Thank you, everyone.
Thank you for your time. Okay.